Hello, I'm Lindsey Torbett. I'm a CPA and CFP and an investor. I was excited to read Warren Buffett's shareholder letter that he released over the weekend. There's some great information in that, and these are my thoughts about that. So he issues that, typically it's the first Saturday in March, and these letters I think are worth their weight in gold for anybody that's an investor or wanting to learn about various companies. They're all posted at BerkshireHathaway.com. They're all public information, and it's a really great service that you might suggest that you go look at. But the major points that, as I categorize them, he made about investing this year are: 1, investing basics; 2, investing rules; he validated buy and hold; he castigates Wall Street; and he talked a little bit about America's long-term future. And as I said, these are my thoughts about those. He actually, in his investing comments, he didn't mention buy and hold specifically at all. But I think these are the truths that he makes in this year's and in prior years. So the first one, the investing basics, he talked about the what and when of investing. And the what is to own a cross-section of good businesses. The when is to buy at the right time. Don't buy at a time of exuberance. Invest over time if the price is really high. But make sure you don't sell at the time of bad news or when the stock was way down. The investing rules he talked about: to buy at a fair price, and that any company's value is based on the future productivity, that is, the earnings. And that's what investors do. And then what speculators do is they base their purchases on recent price appreciation. In other words, they're buying things that are high. And, the goal as an investor is to buy low and sell high. Actually, if you follow Warren Buffett, you might never sell. But regretfully, too many investors buy high and sell low. In his notes letter this year, it's a great example of a couple of different investment truths where he talks about the stories of buying a farm and buying real estate, and how he looks at that the same way as he does his stocks. And I think that's a great point that I oftentimes make with clients, that investing is investing. You need to buy right. You need to pay attention to your investment cost. He also talks a good bit about his circle of competence, to stay in areas where you can value that company. You have a good feel for what future earnings are. And I think right now, as my own comment, when you look at the prices of some companies, it's hard not to say that they're not. It's not a case of a rational exuberance. It may be a good company, and it may do well in the future, but I don't see how some of those companies can be worth the price that they are today when they're making little or no money and they're priced at hundreds of times earnings. I think that's his point about staying in your circle of competence and valuing based on future earnings. As I said, his investment truths are the same whether you're buying a farm, real estate, or a whole company or part of a company, which is what you do when you buy stock, or should do. You have to look at it as a company that you're buying. Is it a good company? Is it going to be a company that's worth more money 5 or 10 or 20 years into the future? I also think he validated buy and hold, which again is just buying good companies at a fair price. You want to buy them at a low or at least a fair price and hold on for a long time. And it distinguishes that from the traders, the people that are buying and selling every day or every week because they think they know what's going to happen in the short term. He makes the point he certainly doesn't know, and if he doesn't know I don't, and I doubt seriously that you do. He also talks about Wall Street and broker harms, and makes the point that you and I and everyone, we need to ignore the noise and the market fluctuations. Makes the point that a flash crash doesn't harm a long-term investor, and that you need to minimize your investment cost. Watch the frictional cost and the complexity. It makes the point that a lot of the people that are pushing you to make lots of actions and to invest in these complex things are the people that are making money by you doing exactly that. So they're doing it for their best interest, not for yours. He makes the point that you don't have to be an expert to achieve satisfactory investment returns. And that an investor that's not a professional investor or a speculator is not at a disadvantage. Because you see, they're making those decisions based on all that noise and what's going on. Or his point is to just buy good companies and hold on through thick and thin. And as long as it's still a good company, you just hang on in there. You have very little cost, you have very little tax impact, and in the long run, I think you'll do much better. And the last point he makes is America's positive long-term future. He makes the point, and I certainly agree, that American business has done wonderfully over time and will continue to do so. And that's the point I think that's so important. He's talking about over long periods of time, not what might happen this week or this month or even this year, but he's talking about 20, 50 years from now. And that's where I think it's so important that you buy good companies and you make sure that they're still good companies, because there are a lot of companies that 20 or 50 years ago were great that aren't even around today. So you need to watch that. But with that, you can really do well minimizing the cost and minimizing the time. It's not that complicated. He has a great example in there of what he's suggesting for the trustee that would manage assets for his wife, if that can be the case in his will. And he suggests putting 10% into government bonds and 90% in an S&P 500 index fund, and suggests that fund at Vanguard. Because the truth is that a lot of those index funds have really high costs for no reason. So you need to be in an inexpensive one. It's a commodity, by the way. But that's for the people that don't want to pay attention to what the good companies are and do that. So that's how I categorize his report, or his annual letter. I suggest you go read it yourself and agree or disagree with my thoughts. And for more information, your free report on the 5 steps to financial independence, go to www.lindseytorbett.com. And I challenge you to begin to build, or if you already are financially independent, to grow that and to do some great things to leave a legacy. But that financial independence can give you the freedom to do what you want, and I think that these financial truths can help. But you've got to begin, and don't let the complexity delay you. For years I got confused by this and that and all the noise, and instead of investing in this or that, I just didn't invest. And I assure you, that's the worst of all things. Whatever stock you pick, it's better than just going and buying stuff at the store. So in any case, I challenge you to begin the steps to financial freedom. I'm Lindsey Torbett. Thanks.